a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
We're talking tech ETFs now with our ETF Research Director, Nina Mishra. So while we have talked about other areas of technology when it comes to ETFs, this is the overall sector, right?
Yes, yeah.
That these ETFs are part of. And so based on that and against the backdrop of tech as the hottest sector so far this year, what do you have to say about tech ETFs?
So as you mentioned, tech is the best performing sector this year. It's up 32% year to date, which is, almost double of S&P 500's gain. And there are many reasons behind this outperformance and why this outperformance could continue going forward as well. Recently, the third quarter results reported by some of the big tech companies have been really much better than expected, and they provided bullish guidance as well. Apple, Google's Alphabet, Facebook, Microsoft, Intel, all reported very good results. And that has boosted further optimism for this sector. And these companies, especially the big tech companies, they're just getting bigger and better. they are just getting so good at whatever they do. And since they have a lot of global revenue exposure, the improvement in global economy, the synchronized pickup in global economy is also helping them.
Well, they certainly seem to have their finger on the pulse of what their respective audiences want.
Yes.
Right? Even in the segments that they produce in.
Yeah, you're right. And then most of these big tech companies, because they have been generating so much cash, they have huge cash piles on their balance sheets. And over the past few years, many of the big tech companies started paying a dividend. They have been returning a lot of cash to shareholders in the form of dividends and share buybacks. In fact, Apple is the biggest dividend payer in the world now. And a lot of this cash is parked overseas. And they have not been willing to repatriate that cash because of tax implication. And if we get a repatriation tax holiday, then many of these companies will bring back at least some of that overseas cash and utilize it for further increasing dividends and buybacks and investments and M&As, which will again be bullish for the sector.
But as it stands right now, with all this cash that they're sitting on, regardless of where it's at, it makes them less vulnerable to interest rate hikes?
Yeah, sure, because they already have so much cash on their balance sheet. Their balance sheets are not much leveraged. So when interest rates go up, they will not be much vulnerable to rising rates. M&A activity in the sector has been strong this year. In fact, recently Broadcom made an unsolicited bid for Qualcomm for $105 billion, which if completed would be the biggest tech deal ever. And if we see the tax reform anytime soon, then we should see more M&As also in this space.
That's interesting.
And of course, there are new and emerging growth opportunities for these tech companies in the areas of e-commerce, data storage, the Internet of Things, artificial intelligence, virtual reality. That is why they have been growing and they will continue to grow.
Yeah, digital certainly seems to have achieved a place of prominence in most people's lives.
Yes, the world is becoming more digital and creating more opportunities for these companies. Now, as you mentioned, that we have discussed many subsectors, ETFs that focus on many subsectors of technology, which have been really pretty hot of late, like semiconductors. We have discussed robotics, Internet of Things, cybersecurity, ETFs. But those are more volatile and should be I think they should be held as tactical holdings in the portfolio. For long-term focused core portfolios, I usually like to recommend these broad ETFs. They are very cheap, very liquid due to their popularity, and they provide a lot of exposure to these big tech names.
Okay, so you brought two examples of what you're talking about. The first one, Technology Select Sector Spider Fund, XLK, the ticker.
Yeah, so this is the most popular technology ETF. It has more than 19.5 billion in assets under management. It's pretty cheap, with an expense ratio of just 14 basis points. A slightly concentrated exposure with 72 holdings, of which top 10 holdings account for almost 60% of the assets under management.
Wow.
But that is how the tech sector is. Big tech companies dominate the entire space, with Apple accounting for more than 15% of the allocation. So it focuses mostly on large cap, and it also holds some mid cap names, but no small cap names. It's a Zacks rank number 2 by ETF.
Okay, and then there's the Vanguard Information Technology ETF.
The ticker is VGT. This is also very popular technology ETF with 16.5 billion in assets under management. It's one of the cheapest one with an expense ratio of just 10 basis points. It is more diverse with 361 holdings. It holds large cap, some mid caps, and even some smaller cap names. But because of the nature of the tech market, again, tech sector, again, it is top heavy. Top 10 holdings account for about 56% of the portfolio, and Apple accounts for about 14% allocation. This is also a Zacks rank number 2 by ETF.
So have these two been around for a while?
They have been, both have been around for a while.
So they've got a track record.
Yes, yeah.
And apparently a pretty impressive one.
Yes, definitely. Very impressive. They're very good for long-term focused investors.
Okay. Well, thanks for the information. Do you own either of these two?
No, I don't.
Okay. Check out more ETF information on our website. All you need to do to get to all of that information is use the Funds tab in the top toolbar on our homepage, Zacks.com, and it will help direct you to the ETF section of the website. Meantime, with Nina, I'm Terry Ruffalo.